Hello again, everybody, and welcome back to the Angel. And I guess it's not quite right to say welcome back. This is the inaugural broadcast of the Angel, a companion podcast to the Accelerator. I'm Michael Conniff, your host for both, and we are attempting to bring together investors, family offices, angels, VCs with startups and founders and accelerators and entrepreneurs. So we're very happy to be here today with our inaugural guest, Brian Wayne. Welcome, Brian.
Thanks for having me. Very excited. Very
I'm,
pleased for you
I'm
to bring me on board for this inaugural.
yeah. I don't know
Um,
if I'll
podcast.
try not to call you a guinea pig, but but I appreciate you're a good
I've
sport,
been
and I
ca-
appreciate.
I've been called worse. It's all right.
Yeah, yeah, I appreciate you doing this. And Brian Wayne is the co-founder and director of the venture credit strategy at, pardon me, the impact venture credit strategy at Aegon Asset Management, based in Los Angeles. And he's had a long road to get here, which I want to talk about. But what I'm very curious about these days is, in particular, let's start with this group that you're in right now. You call it Impact Venture Credit and Impact Venture Credit, and also lending and investing. How do you define impact in this context, in the context of your company?
It's a great question. It's a great question because impact is definitely a term that's used in a lot of different capacities in the investment industry, in the philanthropic space, and it's really about the intentionality and outcomes, and ultimately additionality. What is being solved and created and measured. So when we look at impact is there's a materiality to what you're investing in, and those different types of outcomes can be measured via KPIs to be solving something. So we look at it as, in the particular case of impact venture credit, we focus exclusively around climate technologies. So think about, mitigating, adapting around, carbon emissions, GHG emissions, to really solve for things around climate change. And when we think about impact, it's really about understanding when we're deploying capital or investing in companies that we can track certain KPIs and understand that our deployable capital is actually making meaningful and material change over time as the companies grow, and we're supporting that growth. And either be them reducing waste or them mitigating carbon via using, renewable energy. Those type of things are all trackable, measurable.
And and so it's interesting. So you're sort of starting with the outcome and in a way working backwards, but there's a level of, maybe not a moral judgment, but you're making a judgment on what it is necessary. Forgive me for saying this, but to save the planet, essentially, what are the things we have to do now to make sure that we are here in 100 years or 200 years? So, how certain are you of the outcome, and the outcome as a positive manifestation of impact? So, having a positive impact in mind, it's still a bit of a guessing game, isn't it? At least to some degree.
Yeah, so through my journey, I've participated in various areas of the investment landscape in the public markets and private markets, and a lot of which has been in private markets across private equity, venture capital,
Mhm.
private debt, and I find that direct investing in opportunities, or a version thereof, even if it's investing in funds that are doing direct investing on the private side of things, you can be very intentional about what you're investing in the companies are doing and what those companies are solving for. And so a lot of it is there's I mean endless amount of research dependent on the type of topic you're looking at. So again, when we're investing in, say, a company that's, for example, that is doing something in the solar energy space. And
Mm-hmm.
solar energy, so it's solar energy installation that is going on homes, and it's mitigating the use of either um, you know natural gas resources, or if you're from the Northeast, which I'm originally from, we grew up and had like an oil burner in the basement, which is which is unbelievable to think that that's still the type of technology that's used to heat homes. Um, and But there's also other things on, you know, offsetting the needs of grid utilization. The grid uses things like different power sources that aren't coming from renewable energy. So being able to do that at a clean source of energy, it is quite measurable. I mean, there's statistical evidence that you're augmenting or offsetting what is being for fossil fuel usage, and you can see it through the life cycle from with fossil fuels through the extraction, through transportation, through the utilization and burning to um, and it's just it's a vicious cycle there. So those things are very, and you can get to different types of investments that become uh, more difficult to measure in the kind of externalities. There's been a lot of regulation that is going forth, and led by Europe, for example, in the different types of scope emissions, so scope 1, 2, and 3. And essentially, it's through life cycle um, analysis to understand from cradle to grave what exactly is taking place through the life cycle of something being created. So as a product, and that being said, so from raw materials, where those are coming from, to how they're actually being constructed into a product through the manufacturing, to how it's being used and therefore disposed of, or in a lot of cases we're seeing circularity is a really big topic that we're focused on, and understanding on not only just kind of recycling, but repurposing of inputs, or upcycling of waste materials to then be put back into a process to be reused again. And then you can really track a lot of these attributes.
Give us a real world example.
Sure. So, I mean, there's of things around circularity.
Circularity, or even just examples where you really have can measure the outcome and be confident about the result.
Sure. So, in one aspect, it's looking at what is displacing on an alternative out there. And so those things are quite easy to measure. Is saying, as I alluded to before, you have things that are using renewable energy resources versus fossil fuel. And if you're offsetting the need for fossil fuels, you can certainly measure what that difference is, and you're not creating any type of carbon emissions that you would from burning fossil fuels. I mean, there's lots of different examples of companies that are doing things to really understand how to things around, say, carbon capture technologies. So if you're going to get into
Yeah.
very specific types of things on interesting avenues, there's companies that are doing things that are taking carbon capture type of technologies to essentially either bolt onto existing manufacturing facility like cement or others that are very, very pollutant in their process of manufacturing, and take and capture that carbon, and then take that and then reuse it for something else. So you can change the chemical makeup and put it into you can put it into other products and create things out of it. For example, a company that we're evaluating currently takes methane and puts it with microbes that eat the methane, and therefore, and then it goes into bioreactors or fermentation tanks with other chemicals, and they're able to turn this product into something that is an alternative to plastic. and it's fully biodegradable. And so you take this and it comes out through the whole process. It turns into pellets. Those pellets can be thermal molded into other things. They currently make, things like straws, cutlery, other things. You take this product like a straw, you put it in water. In 2 weeks, it biodegrades. So things like that are fantastic new technologies and initiatives that have been coming out, but have taken a significant amount of time to ramp up to commercialization stage. What's really interesting is the advent and the continuation of various technologies have been supported a lot more so by investors, especially on ones that need things for a level of capital intensity. So that's always been a challenge of nascent technologies that are out there that have a lot of raw material usage. They need infrastructure in place. They need other things, and all of those things need capital. Fortunately, it's continued to snowball in the investment community via a lot of different inputs to and driving forces to have more money go into the space to try and solve things like climate change or social impact initiatives. And it's driven really from a few different areas. Investors on their interest and appetite from certain demographics that really want to have purpose alongside their investment returns. There's also corporate entities that have then been driven via their consumers on the same vein to say, we want more sustainable type of products. We want to see you do things with a better ESG profile. And so they've had many commitments, as you see, from all of the major Fortune 500 corporations that have net zero targets. It's an interesting avenue because there's a direct intersection that's happening between the public markets, like with a lot of these public companies that have net zero targets, and private early stage technology companies, because they're looking to either invest or buy those products because they've committed to them. And then the last piece of it is on legislation and regulation, which has really helped to provide a launch pad for a lot of nascent technologies, especially with more recently with the passage of the Inflation Reduction Act, which essentially is a multi-$100 billion climate change bill to help fund various projects, various technologies that are trying to help mitigate climate change.
So that's really interesting. And I wanted to ask you, I think you're a good person to ask. There's a writer named David Wallace Wells who wrote essentially a doomsday kind of book about climate change maybe 2 or 3 years ago. He's now at the New York Times as a writer, and he has become much more optimistic. He has gone from saying like we're really screwed, we're screwed as many ways as we can be screwed, to saying, well, it's still going to be bad in a lot of ways, but maybe it's not going to be as bad as we thought. Do you agree with that, or can you shed any light onto kind of that kind of thinking? Is there reason for optimism that didn't exist 5 years ago?
Yeah. So for a lot of those reasons that I mentioned just now, there's a lot of rolling change that is happening across the global economy to really shift the narrative generally to say we can actually do things to make positive change in how we are operating our life, business, and trying to adapt to climate change. And that's the piece right there, is adaptation. So I think one of the big things has been for the last several years is how do we curb climate change? It's come more recently to the understanding that we can't fully curb climate change given all of the different externalities and moving parts of the entire global economy and how everyone operates their lives. Can't have a wholesale shift. So there's a complementary type of piece on looking at how do we mitigate various things that are really forcing the warming of the planet, but also how do we invest in technologies for adaptation, because there's things that are going to change. We're not necessarily going to reach, the warming target that we're seeking to do, that has been called out globally. But there's a lot of things that we can do to start to adapt to those different types of needs. So, end of story. End of the day, the narrative is a lot more positive because there's so many more stakeholders that are dedicated and involved globally to help really, really drive a lot of change.
Yeah, don't say end of story. That gets me scared. But end of the day is better than end of the
Right.
story. Um, but Brian, I also want to ask you have been in private equity and venture capital, and now you've moved in your career from Boston to Chicago. Now you're in LA. So there's been a bit of a journey there. But do you remember? And I assume you weren't always in impact investing, so that this was probably a process, I'm guessing. So did you have an aha moment in your career in which you said, I really should be spending 100% of my time on this stuff that I'm assuming it's obvious you care about it. Was there something that happened in your career, or what was it that sort of brought you to this real, or was it dumb luck? What was it that brought you to this place and this realization?
Yeah, it's really interesting. I've had that question come up a lot in the past couple of years, and reflecting back, there's a lot of different elements that have influenced it. When I was in Boston, I started my career at a firm called Congress Asset Management, and it was a boutique investment manager, boutique by forms of investment management. By the time I left, I think it had about $10 billion under management, in comparison to Aegon Asset Management, which is a Dutch-based global investment manager with approximately 350 billion under management. Not all impact investing, trying to get there though. But but yeah, I mean, there's a lot of different things. A lot of the influence I saw was via various clients that we had across the firm, that in different investment strategies that were looking to do things as early as in the earlier, I guess, 2000s, with social responsible investing, SRI, which was driven a lot by different types of clients that really were looking at it, foundations, dioceses, other types of clients that we had that were kind of restricting their view on what not to invest in. And that translated into others where, there was more research and availability of information and data behind companies, and through that, able to really start to think more proactively on more an inclusionary process on like which companies
Mm-hmm.
can be doing things a lot better. Um,
Mm-hmm.
so, one of the big things, honestly, we had a client on the private equity and venture capital side when I was at Congress Asset Management, which was the Electrical Workers Union, and they always looked for opportunities to have more investments that were focused around supporting their pension, which were electrical workers. And a lot of that was, we started seeing a lot of things in the electrification of industries and a lot of growth in those. And think, this is probably 2013, 14. And that started to roll in that aha moment for me on saying, there's opportunities to really invest and invest more directly and intentionally on kind of transition of technologies, of industries that perhaps might have a longer sustainability, not purely on just the economics, but just sustainability from, say, an environmental or social perspective. And so that's really where I started to drive a significant amount of interest. 2017, I joined Aegon and moved to Chicago. And really everything that I was focused on is helping to find opportunities to coalesce the whole investment philosophy globally around responsible investment and the different types of asset classes that we're involved in, and also start some new businesses focused around sustainability and be very intentional about it. Ultimately, it led to 3 years ago, a colleague of mine and I had previously put together a sustainability thesis on long-term secular shifts in sustainability and how to research and identify companies that were really going to buck the trend over a long term via their practices on, say, an ESG profile from their company's operations, but even further.
So this is 5 years ago. 5 years ago, you're thinking this through.
Correct.
Yeah.
And then so fast forward about three and a half years ago, we came back together and we said, we need to do something that's very intentional. My background is a lot in the private markets. Same with my colleague. We need to do something that's very intentional, that's a bit differentiated in the marketplace. I've spent time in venture and private equity, and do something that really supports climate-related type of companies at really the early stage through their life cycle to continue to support their growth, but do it in something that was not very, wasn't really in the market. So there's a lot of really good intentional venture capital equity investors. What we found was really on the kind of creative capital side or debt side of things. There weren't many that were very intentional on doing things around impact and climate. So I said, what if we adapt something that we can do things more on debt type of financing, have equity components to it, be very intentional and hands-on with companies that we're working with, but provide a different type of capital within that capital stack that really helps to drive those companies forward. Because in a lot of cases, venture equity is critically important to reduce the risk, have capital runway to build out pilot projects and tech, but for really on capital scale, adding levels of credit or debt or components that are structured type of capital, it was really missing from the industry outside of like grant funding or DOE loans or other things like that. So we put that together and really just been off to the races for the last 3.5 years. Our platform is funded via balance sheet from our affiliate. So we have a large pool of capital that we're investing in across a number of different companies.
And what's the advantage of that credit, debt approach combined with the venture capital for a company that you invest in? What are the mechanics of it? So, maybe walk us through a scenario, a typical investment scenario.
Sure. So, say a company has been funded that's doing something that in the climate space. They've had a couple rounds of institutional equity funding via, starting from like angel, friends and family, to a pre-seed, to a seed round, to Series A. And they continue to ideate, build out their product or service, continue to try and scale the business, and they reach a point of commercialization. They start to have customers, and they really need scale for growth. What is interesting is, used appropriately, it's just a different form of capital within kind of the capital structure. The advantages are, there's a few different types of advantages for having kind of more creative capital in place. One is that the dilution that you're receiving as a company is mitigated significantly from taking on debt financing,
Sure.
or as I like to call it, dequity, is what we do, because we typically do a combination of some equity and debt. Um, but um, but it's much less dilution. So our overall cost of capital will always be less than what would be just straight equity financing. So all parties involved, it's actually very advantageous. So because of that dilution factor, so existing investors won't have more dilution; they'll own less of the company that they're already invested in. To the founders and the employees, will also reap the benefits of not having that dilution. And we can support specific types of growth. And then the use of proceeds can be very different. So if you think about it this way, sometimes just equity capital doesn't make any sense to fund certain things. So if you're trying to like build a new facility, or build some inventory that's going to be turned over pretty immediately, there really wouldn't be any need to dilute your company down if you're going to see an ROI within a shorter time frame that you would having more quote unquote permanent capital. So it's just kind of conceptualizing, there's different types of, even though, money is fungible, you can use it for very, very distinctly different things if it's segmented that way.
It's so interesting. So we've got a few minutes left, Brian. I wanted to ask you for about a 2 minute look into your crystal ball. This you've got a new approach to this area, to this sector, and at a time when people and governments and institutions are embracing impact, climate change, and really trying to do something about it. So conditions to me seem to be getting much more optimal than they used to be. So what does that mean for you as an investor, and then for you just as kind of an inhabitant of planet Earth? What do you think? When you look in your crystal ball, what do you see on the horizon?
So kind of specifically going down the lane within climate related investing, I mean, I think
Yeah.
just overall, I'm incredibly optimistic because
Hmm.
of a number of those factors and positive forces that are really trying to drive change. And the the overall narrative has shifted dramatically from a storytelling aspect, which I think is really important, which is which has helped to uplift the global picture of what's really going on. So historically,
Hmm.
there's been, and you've probably seen this in your world as a storyteller yourself, and the looking at, it's been a lot of, for years, kind of doom and gloom on what is going on with climate, and there's problems out there and people raising their hands and doing that, but it's a lot of shouting and not much action. And
Hmm.
even from various like media outlets, documentaries or others, they're still had been hinging on, here's the doom scenario, but there's maybe some light at the end of the tunnel. Now, what's really interesting is because there's been such an advent of technology to address a lot of the problems that we're trying to face, um, that
Hmm.
that narrative has really shifted to a much more positive outcome. Like, there is things we can actually start to see a material shift and change, and we can see it even just from um, if you're looking at energy usage, for example. There's been, I think, on a relative basis, a 3x change in just the last few years of the amount of overall renewable energy used by the entire United
Hmm.
States grid than it was just a few years ago. And
Yeah.
offsetting, and that's starting to shift more and more, because also the just cost parity started to get in place, where it's cheaper for renewable energy than it is for using fossil fuel production, and that happened a few years ago
Yeah.
as well. So the economics of it start to make a lot more sense. Um,
That is good
yeah.
news. Yeah. And on the storytelling side, I've for years had discussions with my friends in the environmental climate change movement, and saying, what you're saying is basically, to those who oppose you, is we're right, you're wrong, you've screwed everything up, it's your fault. And I said, there's an opportunity here, and I think this speaks to what you're saying. There's an opportunity here to say, you know what? We're about to partake in the greatest story ever told. It's going to be the story of how people save themselves from themselves. And, what a great story. Maybe the story doesn't have to be we screwed the whole thing up and it's over. Maybe the story is, no, it's not going to be all screwed up. It's going to be fixed. And who knows what that might mean for the world
Yeah, I
moving
think
forward.
there's
So,
exactly right. There's a big thing about, there's the ability for regeneration as well. So things that we've done to the planet that can be restorative, to get a lot of those things from restorative, from, rainforest to kind of ocean, uh, and marine life, which, the oceans is actually the largest carbon sink in the world. And more so
mhm,
than all of the, rainforest and forest combined. So I think
yeah.
there's a big story to be told there, and I'm very optimistic that we'll all be here to tell that story.
Well, you will be. I may not, but you've got some runway. But Brian Wayne is the co-founder and director of the Impact Venture Credit Strategy at Aegon Asset Management, and he has, in this podcast, left me with a nice feeling of hope, a nice warm feeling of hope. So thank you, Brian. Thank you for being our inaugural guest on the Angel. Um, Hopefully this will not be too hard for you to live down over time, but you're very gracious to take the leap.
Thank you so
So
much for having me.
I really appreciate it, and we'll continue this
Love
conversation.
to.
Thanks for listening to the Angel number one, and we'll be back with another podcast before you know it. I'm Michael Conniff. You can reach me at Michael Conniff, MichaelConniff.com, or at Michael Conniff at Twitter. Thanks for watching. Thanks for listening, and we'll be back soon.